We got a great show today, folks. Today, we're going to talk about interest rates and the impact of lower interest rates, the things that you should be doing, understanding the ramification of what's going to happen. We'll start off with a little bit of background of interest rates, and then we're going to dive straight into the impacts it has on our economy, on our infrastructure, on you, and the things that you should be looking at and what you should be doing as we see and hopefully enter this low interest rate environment. So stick around. Don't miss this episode. These are the important pieces that you wish you were told during last interest rate reduction period. Good day. Lots to talk about today, folks. Here we are with the lingering interest rate drop. We have our Fed Chair, Jerome Powell, looking to finally take action. It's last time since December of 2024. So we are going to discuss just a little about what the impact means to you. And I think it's important that you just understand in general, when you look at the Treasury along with the Fed funds and prime rate and so on, how there are two different worlds. And so by understanding yet again the impact this has on your financial situation, which means on your future plans. But before we do that, I want to take a step back and just understand what this means and how it impacts you. Because what I'm going to talk about here in the second segment are six core items of how the interest rate drops is going to affect you. It's going to affect in multiple different facets of your life. So buckle up. But taking a step back, when you look at interest rates and these movements, you have to understand it doesn't just impact what you owe on your home equity line of credit or on credit cards. This impacts multiple different things. And I'll look at it even from an investment point of view. It's pretty simple, right? When interest rates go up, like it did in 22, bond prices drop down. Well, now if interest rates are going down, what do you think that happens to your fixed income and bonds? It goes up. It has an inverse effect. And by understanding the characteristics of why that is important. For example, if you bought a bond today at 6% and now you spend 100,000 on 6%, making you $6,000 a year. And now the price of that drops to 5%. You can't get a 6% anymore. Remember, the Fed chair just lowered rates in this example. Well, now you can only get something paying you $5,000, which is a 5% bond. Your 6% is worth much more. What if you locked it in for 10 years? You're going to have an extra $10,000. For all I know, that bond you have, if it's in year one, is worth 10,000 more. It is actually appreciated by 10%, you can say. This is how it works. But that is looking at from an investment point of view. Let's look at these companies. Some of these companies are highly in debt. No, if they're highly in debt, what does that mean? A lot of their debt is what's called not fixed, which is variable. In the commercial world, they call it floating rate. Floating rate debt means if now they're paying or owe $1 billion at 7% and it drops to 6%, they just saved $10 million a year of interest. You get what I'm saying? It's kind of important. So, this is when you're reanalyzing whether it's in your economic situation, whether it's in your bonds, whether it's in your equities, whatever the case may be, these instruments, fixed income, loans, debt, Fed funds, bank to bank borrowing, prime rate, all of these communicate with each other because, in theory, it stimulates the economy. These are positive things. Now, it's a little wild as we still have housing pretty much at all time highs, stock market at all time highs, gold at all time highs. Everything feels like it's at all time highs. And we're doing these type of things. Oh my goodness. This could be maybe concern of inflation because it's only going to continue to drive these prices higher. So this is where we have to think to ourselves, is this a good thing? Well, if you're talking to me, I would say yes, it is a good thing, but you have to put yourself in position. This is where you have to be smart. With that extra money that you have, maybe start to look to tackle debt that you might be getting. You might be wanting to look at investing more money because these are the number one hedges against inflation. You've had the market go on a tear for the first 9 full months out of the year, up over 20%. And people are like bored now of the Nasdaq and the S&P 500 and the Dow Jones having these record highs. They're no longer happy with 10 to 15% returns. Well, what the hell are you looking for? You have another subset of people that has been so happy not investing in the stock market because they don't want the volatility and they're happy with their 4 or 5% treasury rates. So this is where what I call is the great recalibration, where you're supposed to take a look at everything that changes and recalibrate what you're currently doing. In an investment portfolio, we call that rebalancing. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth. You're on every weekend, and we're talking about all important topics of personal finance. And today I wanted to talk to you about interest rates going down and how that impacts you. And I think it's crucial. And one of the biggest, most important pieces to this that people often miss is the effect on housing. Now, housing has a direct correlation for when interest rates drop. Think about it. If interest rates drop, you're probably going to refinance your house, right? So now it becomes that much more affordable for two reasons. Number one, it's a lower rate. Number two, you're probably 1, 2, 3 years into your current mortgage. Well, now you're refinancing again over 30 years. Now I know what you're thinking. I don't want to refinance because I only have 27 years left. Hello, you're not understanding how math works. So let me help you. It's as simple as this. Well, if you had a 5% loan, now at 4%, you're going to have a lower payment. If you really wanted to pay it off faster, just make the same payment you were making before. You know why you're going to pay it off faster? Because 4%, you're paying less interest than 5%. By lowering it down by that 1% difference, that alone could save multiple years off. What does that mean? Yeah, it's a 30-year mortgage, but if you pay extra and treat your current rate like your old rate, you're going to pay it off multiple years faster, not just in 27 years, but probably 24 years or even faster. So this is where the law of numbers, it helps to get a second opinion. If you're not good at numbers, get a partner who is. If not, listen to shows like this because it is huge in saving you money. So we all save more money now, right? That was refis. Well, let's just say you have, and we're looking at a $500,000 home. If you were going to put 20% down, that's $100,000 down. You have a loan of $400,000. If your rate was 7.5%, well, you could only afford that house of 500,000. Well, let's just say you are comfortable with that. I'm going to make up $3,000 a month. Well, if rates go from 7.5% to 6%, maybe you can afford a $600,000 house. Why? Because the interest rate is lower now. So it allows you to be able to buy more of a house. What do you think that does to housing prices? That is the first impact I want to make sure I share with you guys on the importance of this episode of what happens with interest rates. Housing prices loves low interest rates. It's awesome. Finance companies also love low interest rates because this is where they're doing more lending. Things are more affordable. People are doing more writing and refinancing as well. So you have to know these benefits are going to benefit you, especially if you're looking to buy a house. Remember, the current administration wants to try to make homes more affordable for you. Well, if you're a cash buyer, probably not good because why? Homes are going to go up. If you're a cash buyer, you want interest rates to be at 10% because homes are that much cheaper for you to buy. And yes, home prices have softened all throughout the country. You're looking at some places with a 10 to 20% drop from places like Florida, Texas, and Arizona, and all across. It's funny. Some of the property home that have appreciated, increased the most are also the same ones that get slapped in the face the most when things go bad. So housing is also big. And we talked about this earlier with debt. I talked about it with Fortune 500 companies owing $1 billion, but this also can help us, especially if prime rate gets adjusted. When that happens, we save money on our payments. Our home equity line of credit that most of us have on our house, that is based on a variable prime rate. That drops a quarter, we just saved a 1/4% on interest. You owe $100,000 on that? Well, what's a 1/4% on that? I don't know. Well, 1% is what? $1,000. 1/4% is 250 bucks. So you save money any way you slice it. My comment to you is look to pay that down as fast as possible. Continue to make the same payments that you're making before. Some people have credit cards. Those credit cards are giving you what, 20, 30% rates? Well, when those rates drop, the credit card rates also do drop. Personal lines of credit is the same way. And for those of the small business owners that are out there, a lot of your debt is also floating rate or what I call variable. rates, not fixed, but variable. And in times like this, it makes sense. Now, the reason I don't like homes being variable because I look really smart when I told people to lock in that 30-year mortgage, right? Especially when you were getting at 2.5 to 3%. Well, now if you try to refinance, you're going to be what, six, maybe under 6%? Yeah, I like the idea of locking in these ultra low rates when you can. So, debt is huge and it's a direct impact and benefit to you when rates go down. You can borrow more. Now, we still have a few other things here to talk about, but what we're going to do is we're going to take a quick break. And when we come back, I'm going to talk about a few other benefits of these interest rates and how it can positively impact you and things to be looking out for. I'll be right back after a few words. Welcome back, folks. This is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here. And every weekend, we're talking about all important topics of personal finance. And I said I was going to dive deep on what impact does the stock market drop have on you. And so, with that, I talk about housing, I talk about debt, I talk about what happens in the equity markets and the debt markets, how when interest rates go down, bonds go up. And then I also talked about housing as well. So, we talked about a few things, and now let's dig deep. And what typically increases during interest rate reduction and stimulates the economy is consumer spending. That's you and I actually spending more money. So that's us buying more goods. Some people, I would say, buying more junk, unnecessary things that you don't need. Hence why it stimulates the economy. We feel we are richer. We feel like we have more money. So as we're buying more crap that we don't need, it actually increases and the economy increases our GDP and helps with the businesses that are selling that crap that we don't need. So, yes, take that into account that just because you have extra money, how about two ideas? Number one, pay down debt. Number two, how about you increase your 401k and save more? I get it. It's boring. And it's in a bazillion years from now when you're not going to ever touch it, you feel like, but man, oh man, it's going to feel a great feeling of confidence when you're saving money, investing money for your future. Then you can go and enjoy your car that you always wanted, that Audi you always wanted, or whatever it may be. So the idea is go ahead and take that step back and don't fall into the trap, but that does happen. So be ready. Leading to cars and Audis, car prices also become more affordable because loan prices are a bit lower. So now you're going to start seeing a lot more of these 0%, 0.9%, 1.9%. They're going to try to get those car sales, especially now that you have certain people and subset of people where you can write off car loans. It's a write off for a lot of Americans now. So this is huge for you. So yet again, I'm not trying to tell you to get a loan. I'm not trying to tell you to go buy a new car, let alone an Audi. But the idea is you're able now to take a look and see that car prices are going to start going up. The car sales, manufacturing will start going up. More sales are going to happen nationwide because the interest rate drops. So that's what it means. Let's continue on this journey. Another thing you're going to see increase is the labor market. Yet again, now that companies have less expenses, they can afford to get more people. People help them grow. You got to understand how companies work here. If they're paying you $10 an hour or $100 an hour, they better be making $20 to $200 an hour. So their goal is to make money. If they just saved money, the best thing they can do is reinvest in their company because they know, almost like a form of insider trading, they know what's the best investment and where to put that additional staff. So you see labor force increasing through interest rate declines. Continuing the conversation on constructions. So, excuse me. On construction, you actually see also that starting to increase. Why? Because people are borrowing on home equity line of credits. People are going to banks for additional projects and so on. These are things that, yet again, help with housing. These are things that help with the economy because you got to understand when you build a house, you're buying what? Steel, wood, lumber, concrete, nails, and the workforce to put that all together. Then you have engineers that are helping in that, architects that are helping with that. Multiple people's hands are going into building a house. So, what are we talking about here? These are a stimulation of our overall economy, where one thing affects multiple other things. You can look at something as simple as a cell phone and the components in a cell phone. How many different companies are putting that together? How many different pieces are that are putting that as a part of that? Excuse me. So all I'm saying is, in general, what happens with the interest rate is a trickle effect. The reduction of interest rate helps increase our economy. There is a byproduct of potential inflation as more people spend when something like that happens. But the benefit of this is you. If you put yourself in position where you have cash on hand, where you can pay down debt faster and put your money to work for you, you will come out a winner. The best time to start saving and investing was yesterday. And I don't care if you're in your 20s or 30s, you have the world ahead of you and you have no excuses. And I definitely don't care if you're in your 40s and 50s, because as I've said before, if you have $300,000, you're halfway to a million. Why? Because of compound interest. It could have taken you 10 years to get to 300,000, but in 10 years you can probably get to a million just by compound interest alone. It's almost like you're doubling your contribution amount when you look at the growth. So be positive, be disciplined. We've got a lot of things working in your favor. Volatility is going to happen. But can you control that? The answer is no, you can't. And because you can't control it, focus on what you can win at. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. And what I want to talk to you about is the impact on the economy and what it has. And the last piece I was going to talk to you about, probably the most important piece by far, is when interest rates are low. This is where people, consumers who are happy earning 5+% in treasuries and bank accounts and so on, have to deploy their money somewhere because they're no longer excited about a 2 or 3% return. So this is where they look to deploy their money into the markets. And this is something even that private equity firms do and hedge funds do. And when debt is low, they're able to utilize and leverage that debt to buy more businesses, buy more stocks, buy more companies. This is where people spend more on research and development. This is where other people factor in a lot different and a lot more benefits and a lot more starting of businesses because the business loans and everything out there makes it that much easier. So it helps the economy with now new ideas, new concepts, and expansion. This is what our country is built on. If you look at some of the multi-billion dollars companies that were out there, it's not just founded in a garage, but it's founded sometimes with debt. And debt is 2 times more than our equity. What does that mean? Our stock market is worth 100 trillion. We have 200 trillion in debt. And what it means is you have to understand how to utilize it. The crazy part is the rich understand that. What's interesting about that is businesses understand that, successful businesses, but most people don't. I'm not telling you to go into credit card debt because we've seen the complete mismanagement of that. But by utilizing it properly, it can significantly increase your net worth and have you achieve the goals that you want a lot sooner. That was a fast show, folks. I want to thank you for tuning in with us this weekend. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go and visit our Knowledge Center, which redirects you to YouTube. We have over 1 million views, folks. And if you want us to discuss anything on YouTube, on the show, whatever, send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And if you want this episode, any one of our previous episodes, you can go on podcast, Spotify. We have them all there. And folks, we want to thank you for your trust. We want you to feel free and feel comfortable to reach out with any questions that you have. I want you to have a fantastic weekend. Have a great week, and God bless.